Hey everyone, this is CNA Gupta. I welcome you all on this channel. So recently there's a hype in the US stock market. Around the globe, people are more interested in doing investment in the stock market of the US. So I understand that there is obviously a good rate of return in the US stock market. Maybe this is the reason that people are more interested in doing trade over there. But do you know that it is heavily impacting your taxes? Because I think that government is not liking this strategy much, that people of India are investing in the outside India. So that's why there's a different taxation on the US stock exchanges, or we can say that from the abroad, if you're getting any capital gain from outside India, then there's a different capital gain rate or capital gain tax rate. But if you're getting any gain here in India, then there's a different capital gain tax rate. So you need to understand this difference before investing outside India, because obviously it will help you to understand your actual investment or actual profit that you are earning. Because if you are earning high but you are actually ending up by paying more taxes, then obviously it is of no use. So it's better to invest in India with the lesser tax rate. But yes, you have to compare, you have to prepare actual calculation of both the investment and both the returns with the actual tax rates. So without wasting much more time, let's start this video. Do you know that in the most of the countries, especially in the US and UK, if you are a foreign resident and having the short-term or the long-term capital gain from either the stock market or the mutual fund, it is tax-free. But here in India, it is taxable. However, in the outside India as well, if you are a foreign resident, but if you are doing any investment in the real estate market or the property, let's say if you are selling or buying it, then if there's any capital gain, then it is taxable. Now let's understand the tax rate here in India if you are investing in the share or the mutual fund that are actually listed in the foreign exchange. So if you are having any income from the long-term capital gain, now let's understand first of all what is long-term capital gain. If you are holding any share for more than 2 years, then it will be treated as long-term capital gain, and the long-term capital gain is taxable at the rate of 20%. If that is coming from the foreign exchange, foreign stock market, then it would be taxable at the rate of 20%. That is also after indexation. Second point is that you know that every year 1 lakh annual exemption is there in the LTCG, which is not there if you're getting any long-term capital gain from the foreign stock exchanges. So this is the second loss actually that you need to bear if you are investing in the foreign exchange market as per the definition of the income tax. So if you are investing in the foreign exchange market for less than 2 years, then it will be treated as a short-term capital gain and it would be clubbed in your total income, and you have to pay tax as per your total income tax rate. But yes, you have to take a one point that if they are ESOP means employee stock options, and the second is RSU, that is restricted stock unit, then also it will be treated as same, that it would be clubbed in your income. Now let's come to the very important point, and that is how to avoid double taxation. So double taxation means if you are investing in outside India, and in that country also there is a taxation on the long-term capital gain or the short-term capital gain of mutual funds or stock market. In that case, what you have to do, that if let's say you are paying taxes over there and India is having DTAA with that country, DTAA is double taxation avoidance agreement, then in that case you can take the credit of that amount here in India after filing your ITR. So in this way you can avoid the double taxation, because you already paid over there, so you are not supposed to pay taxes over there again in India, because otherwise there will be double taxation. So you can avoid that. But yes, you have to refer the correct double taxation avoidance agreement, and also you have to obtain the tax residency certificate. And you also have to check that whether India is having the DTAA with that country or not. India is already having a DTAA with more than 150 countries, including US and UK, so you have to check it out. Again, a very important point, that a TCS liability you have to follow, that if you are transferring funds from India to outside India, which is more than 7 lakh rupees, in that case 5% TCS liability will be there. then all that it means that your 5% TDS will be deducted and you can claim that amount after filing your ITR. But yes, if you are transferring more than 7 lakh rupees, then you have to take care of the TCS as well. And a very important point that usually people skip this thing, that if you are having any foreign asset, you have to report it in your income tax return. No matter what, that if you are having any income or not during the financial year, but you have to report the foreign assets. It's a compulsory thing. And you have to file ITR 2. You cannot file ITR 1 if you are having any foreign assets, because disclosure requirement is there only in the ITR 2, not in the ITR 1. So the proper selection of the ITR form and also to disclose the foreign assets, it's also required, that usually people skip this part. So now I'm discussing that what are the foreign assets that you need to disclose. So here's the list. First is equity and debt instrument, second is custodian account, third is depository accounts, fourth are cash value insurance contract or annuity contract, fifth is financial interest in any entity, sixth is immovable property held, seventh is trust where the taxpayer is a trustee, a beneficiary or a settlor. So these are the foreign assets that you need to declare in your ITR, and you have to take care of this point as well. So you have to check that if ITR 2 is applicable on you or ITR 3, then accordingly you can choose your ITR form and can file your ITR, but not ITR 1, because disclosing option is not there in the ITR 1. And also ITR 1 is also not there for the capital gain. So either ITR 2 or ITR 3 that you have to select. So these days we have a new mutual fund where the foreign exchange exposure is also there in that mutual funds. In that case, you have to check one thing, that if the exposure is of more than 65%, it means, let's say that if the stock is having exposure of more than 65% of the India only, in that case normal tax rate will be applicable. Normal tax rate means that Indian tax rate will be tax rate of the long-term capital gain will be applicable. It means the short-term capital gain, if you're investing in any stock or in the mutual fund for less than 12 months, then it will be treated as short-term capital gain and it will be taxable at the flat 15%. But if you are holding it for more than 1 year, in that case you have the 1 lakh exemption, 1 lakh exemption as well, and also the tax rate would be 10%. So the normal tax rate of the long-term capital gain or short-term capital gain will be applied, not of the foreign exchange stock rate. Next point is, if you are investing more than 65% of the mutual fund, that is of the outside India, or having the exposure of the foreign assets, in that case you have to pay taxes of, as I discussed earlier, that 20% taxes will be there if it's LTCG, and if it's short-term capital gain, then it will be clubbed in your income itself. So this is all about for today, and if you have any related query, you can ask me in the comment section. I would love to help you, and if possible, please share this video with everyone in your group who are actually investing in outside India, so that they can also understand the taxes on it. And let's meet in the next video. Till then, bye bye.